DSCR loans are increasingly used by real estate investors to scale their portfolios. Known for easy qualification and light documentation standards, sophisticated investors continue to use DSCR loans after maxing out on conventional financing or simply finding it's not worth trading the time and hassle of a bank qualification for slightly lower rates. The savvy DSCR loan borrower will use all of the available options to optimize terms, especially in volatile rate environments like today, where every little bit of rate matters in securing profitable investments. Prepayment penalties. The best way to get the lowest rate on a DSCR loan is to allow the lender to place a prepayment penalty on the loan. Essentially, that means for the first few years of the term, if you choose to prepay the loan early, either by selling or refinancing, you'll have to pay a fee equal to a low percentage of the outstanding loan amount, usually 6 months interest. If your DSCR loan contains a prepayment penalty, then your rate can generally be significantly lower, up to like a full percentage point, 100 basis points, depending on the structure of the penalty period and amount of the penalty fee. Why are the DSCR lenders willing to give better rates if there's a prepay? Well, it's because most DSCR loans are securitized and pooled into mortgage bonds. And for investors such as pension funds or insurance companies, they want to rely on that consistent income and predictable cash flow. And if your loans are being refinanced and sold, it would jeopardize that cash flow and the ability to market as such. Prepayment penalty structure options will vary from lender to lender. However, the most common are step-down structures, such as a 5-4-3-2-1 structure, which means that if it's prepaid in the first 12 monthly payment dates, the fee is 5%, 4% the second year, 3% the third year, and so on and so forth. DSCR loans are made for investors with long-term horizons, building portfolios for the long term to earn cash flow and appreciation. Thus, if you're an investor using DSCR loans to build a cash flow financial freedom portfolio, you likely aren't planning on selling properties in the 5-year period, so why not take advantage of the prepay? It's a great lever to pull. Now, here are some quick things to know about DSCR loans. They're generally available in the ARM variety, and the ARM typically refers to the initial part of the term where the interest rate is fixed rather than to the full term of the loan. Now, unlike in the early 2000s when ARMs started floating quickly, DSCR ARMs are more of a hybrid product, better described as a fixed to ARM. Whereas discussed in the bullet point above, they have a fixed rate for a significant period to start the term, typically 5 to 7 or even 10 years. These are typically expressed as two numbers separated by a slash, such as a 5-1 or a 7-6. The first number refers to the initial years of the fixed rate term, while the second number refers to the frequency of rate adjustments after the fixed rate period has expired. Long-term rental qualification versus short-term rental. This biggest trend in real estate over the last few years has seen investors turning to short-term rentals versus long-term rentals, primarily for the significant difference in cash flow and profitability. However, many DSCR lenders view short-term rentals as riskier and prone to disruptions in cash flow and in viability due to greater dependency on the broad general economy, seasonality, and regulatory risks. The current trend among DSCR lenders currently is to either stop lending on short-term rental properties or qualify these properties based on how they would perform as long-term rentals, or just charge higher rates if the property is an STR, short-term rental. Now, strategic LLCs and entity structures are a final advanced strategy to structure the borrowing entity to maximize credit. One of the key advantages of DSCR loans versus conventional financing is the ability to borrow through an entity such as an LLC. While there are pitfalls to avoid, investing in real estate with a partner or partners that have complementary skill sets has been a tried and true recipe for big success in real estate investing. Now, in conclusion, DSCR loans are increasingly popular because of flexibility versus the standardized requirements of conventional financing. The ability to customize the structure to fit your investment needs allows borrowers and lenders to work together for win-win loans and long-term relationships. Now, hopefully this article helps your understanding of how best to structure your loans and how to pick the DSCR lender that allows the flexibility and options you need. Every bit counts in this topsy-turvy market that we're in right now. Now, if you're in need of an experienced commercial real estate broker, I can be reached at 281-222-0433. Thanks for your time and hope you have a good day.